Commission is a compensation which may or may not be paid to the partner. The partnership deed mentions about the commission to be paid, and if the commission is paid, it is generally paid on the net profit or on turnover. Commission is either paid before or after charging such commission. Therefore, one has to be very careful while reading the question, how has the commission been given? If the commission is given before charging such commission, then directly the percentage is found out. If it is calculated after charging such commission, then the percentage is added with the denominator. For example, if 10%, then the percentage of commission will be calculated as 10 by 100. However, if it is 10% after charging such commission, then this 10 will be added with the denominator, which is 100, and the valuation will be done on the basis of 10 by 110%. Now, in this question, you can see A and B are both entitled to a commission at the rate of 10%. A is paid a commission before, while B is paid a commission after charging such commission on net profit, which is 2,20,000. Now, when the commission is before, it will be a simple percentage, which you can see the calculation. A equals 2,20,000 into 10 by 100, which gives you 22,000. And when it is after charging such commission, the denominator will be added with the percentage, and therefore you can see A 2,20,000 into 10 by 110, which is giving you 20,000. Therefore, the commission of A is 22,000 and the commission of B is 20,000. Now, if you can see the next case where we have taken two partners, X and Y, both are entitled to commission of 15%. X is paid a commission before, while Y is paid a commission after, and the net profit is given as 2,30,000. So X calculation, 2,30,000 into 15 by 100, just ordinary percentage, 34,500, and Y 2,30,000 into 15 by 115, which gives us 30,000, because over here the denominator was added by the percentage, that is 100 plus 15 becomes 115. Now let us understand the journal entries on the basis of the two above calculations where we had A and B and X and Y as partners. Now you can see in the first sum the total commission for A was 22,000 and for B was 20,000. Therefore the total commission came to 42,000. The journal entry is commission account debit 42,000 to A's capital to B's capital, 22,000 and 20,000 respectively. Commission is the expense for the firm, therefore it will be posted in the debit side of the profit and loss appropriation account, and you can see the journal entry which has been passed. Profit and loss appropriation account debit 42,000 to commission account 42,000. Similarly, in the second sum, we had two partners X and Y, and the commission given to X was 34,500 and commission paid to Y was 30,000. So total commission was 64,500. So the journal entry is commission account debit 64,500 to X's capital 34,500 to Y's capital 30,000, and this entry will be transferred again to the profit and loss appropriation account debit side. Therefore the journal entry will be profit and loss appropriation account 64,500 to commission account 64,500. Apart from interest on capital commission, the partner can also be paid a salary. The partnership deed may or may not provide salary to partners. If salary is provided to partners, and since salary is an expense for the firm, it will be entered in the debit side of the profit and loss account appropriation account. Now the journal entry for that is salary to partners capital, and the transfer entry is profit and loss appropriation account to salary account. We'll now try to understand the partner's capital account. There are two ways in which the capital account can be prepared. One is called the fixed capital method and another one is called the fluctuating capital method. In the fixed capital account method, there are two accounts which are prepared. One is called the current account and one is called the capital account. The current account records all the transactions which has been passed in the profit and loss appropriation account, and the capital account only records the capital at the beginning of the year, and if any additional capital has been invested or any money has been withdrawn from the capital, that only is recorded in the capital account. Therefore, both capital account and current account will have balances. Sometimes current account may not have balances, but the capital account will surely have balance. If the capital is fluctuating, only one account is prepared, which is called the capital account, and all entries which are there in the profit and loss appropriation account are transferred to the capital account. In this slide, I'll explain to you the format under the fixed capital. That means we will see the capital account and the current account. The capital account generally starts with buy balance brought down, and here we have taken two partners A and B. So we will have buy balance brought down at the beginning of the year and to balance carried down at the end of the year with the same amount. Another account which is prepared when the capital is fixed is called the current account. The current account may or may not have a balance. It may have a debit balance and credit balance. That is the reason why I have shown you the current account with buy balance brought down and to balance brought down. Please don't get confused. It will either be a credit balance or a debit balance. It cannot be both. That means that A or B both can have credit balances. A and B both can have debit balances. A can only have credit balance, B can have a credit balance, and so on and so forth. Now, the next entry in the current account is by interest on capital. The next entry is salary. The next entry is commission. And the final entry is by profit and loss appropriation account. That is the profit which we have got from the preparation of the profit and loss appropriation account. These are the items which may be there in the current account. However, it is not necessary that all these items are there. It is not necessary that there is an interest on capital or salary or commission, and neither it is important that there is a profit on the profit and loss appropriation account. The two items which are there in the debit side of the current account is drawings and interest on drawings, and if there is a loss, it can be transferred to the debit side of the current account as to profit and loss appropriation account. The balance will be found out. The balance in the current account can be in the debit side or it can be in the credit side also. If the capital is fluctuating, then we need not prepare the current account and only one account, which is the capital account, is prepared. And you can see very carefully that we have prepared a capital account and we have started with buy balance brought down of the capital, and if there is any additional capital we have posted as by bank, and then by interest on capital, by salary, by commission, and to profit and loss appropriation account. Similarly, in the debit side you have to drawings and to interest on drawings, and finally we find out the balance. So in simple words, if it is a fluctuating capital, both current account and capital account will be merged together and only one account called the capital account will be prepared. Remember this, that we are preparing the capital account either in the fluctuating or in the fixed method to find out the balance of the capital of the partners at the end of the year, which will be required to prepare the balance sheet if it is asked in the question. Thus, we can conclude that the partner's capital can be kept either fixed or fluctuating, and all entries which are there in the debit side of the profit and loss appropriation account will be transferred to the partner's capital or current account, and the entries in the credit side will be recorded in the debit side of the partner's capital or current account. So the transfer entry is very, very important because it is required to find out the balance at the end of the year.